please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Commodity Champions, and what a week it has been, where we have seen a sell-off come in equities, commodities and other asset classes as well. But there has been one sector which actually saw some good coming its way, and in form of government measures. Well, the sugar prices are trading on the higher side, and this is on the back of import duty being hiked from 50% to 100%, and the government also has come out with a reverse release mechanism for the sugar mills. So if last year the sugar consumers had it good, this year around it is the sugar mills that the government is looking to support. Joining us now on the show is Kunal Shah of Nirmal Bang Commodities, Priyank Upadhyay of SSG Finance. But we will talk about the sugar prices first, and for that let's get on board Director of Balrampur Chini Mills Vivek Saraugi and Director General of Indian Sugar Mills Association Abhinash Verma. Gentlemen, hi, thank you so much for joining us. As I said, let's talk about sugar first, because there is so much happening on to right now. Vivek, coming to you first. The government is working for the mills as it puts the release mechanism in place to support the prices. How do you see it? Is it really, coming back to controlling the sugar as a space which we saw decontrolled long back in 2012?
See, Manisha, if we see what happened last year, the government behaved very responsibly in favor of the consumer. They said that you cannot hold more than so much in October and November. Those are the festive periods and the lowest stock period for the year. Now, when you have got into a surplus zone, mills are just, running over each other on a panic fear factor. The government has come out with the same measure again for 2 months. It's February and March, when the stock is going to be the highest in the year. So I appreciate this measure. I think it is a rational measure. The price has already reacted to it. Mills, UP, like we were selling at sub 31 prior to this. Then after the clubbing of these two announcements, prices have moved up to above 32. Now these are prices, Manisha, which are still way below cost. So I think this measure was in good time.
Well, yes, that point is well taken, because we have seen the sugar prices actually decline by 15% in this season, while the cane prices were surged or hiked by 11%. So yes, of course, there has been a bit of a mismatch there. But Abhinash, coming to you, will the limits ensure, on one side, of course, that you will see a price rise, but that would also mean that the mills will be holding higher stocks here? How do you see that actually calculating on itself?
See, there is a certain limit to the sales that anybody can make every month, because the market takes what it requires. And if you look at the average sales that can happen, the market requires around 20-21 lakh tons every month. So if somebody tries to sell more, the market doesn't take. And in fact, if the supply is more, the prices keep continue to drop. And that is exactly what has happened in the last 2 months or 3 months. The prices have come down by anywhere around 6 to 7 rupees per kilo, because people were trying to sell more than what the market was able to take. So what the government has done now is a reverse stock holding limit, and has put a maximum that each sugar mill can sell in the country. So at least the distressed sugar mill who were trying to sell more by dropping prices will get controlled. And not only will the market sentiments improve, but what will happen is people will not be actually selling more than what the market is taking. That is number one. Number two, now that we are seeing that the prices have started improving for the last 3 days or 2 days, and improved by almost about 1 to 1.5 rupees, the stockists and the traders will now find some interest in the market. They might buy something more for stocking purpose. So the demand, I believe, could be more than about 20-21 lakh tons. But this method of controlling the sales by sugar mills by putting a restriction of 17%, the numbers work out to about 20-21 lakh tons. So the supply will get controlled at 20-21 lakh tons, but if the demand is more than that, the prices should slowly crawl up.
And that, of course, is something that the industry is looking at. But Vivek, coming back to you, as a mill, of course, the holding capacity that you would have to hold all of that sugar, would you say that now that you are being restrained for the next couple of months, what does that mean for the mills holding on to that kind of a sugar? So are you looking at those kind of rise in sugar prices that it can compensate for your holding?
Yeah, see, Manisha, you've hit like 2-3 separate points, though they're connected. See, if you cannot sell all your sugar in one day, the panic situation was leading to lower sales and lower prices. Post some discipline, you will see higher sales with higher prices because you're scaring away the trader. So it's a psychological move. It is a good move. And the fact that if you have to restrain yourself for 2 months, it's not bad because you have the genuine high demand period coming up. So I don't see this as, strangulation, because you sense, there is extra production. Yes, there is. Next year there will be more production. Yes, there will be. But these 2 months disciplining will get you to a basic price level. Thereafter, one looks forward to, exports from the government, assistance there, some assistance from the state. So, you live to, you stay another day. You live to play another day.
Well, yes, don't you? But, while, of course, the government has been making a lot of measures, Vivek, import duty has been hiked to 100%. There is also export duty that could be scrapped, which stands at 20% right now. There could be some actual measures coming in for mills to export as well. As you said, this is more sentiment than actual. Would you say the actual measures that the markets would see in sense of numbers, is that something that could actually go forward and support prices?
Manisha, commodities are, a lot sentimentally driven, speculative driven. So yes, these are sentiment positive measures. Export duty doesn't exist because the day the government will come out with a subsidy for export, the export duty is meaningless, It's just a notification which has to be overturned. So I don't see that export duty removal as any sentimental measure also. But yes, the major thing which would be now needed to be done is to evacuate the surplus. We are in dialogue with the government. We've already requested. We've put up, sort of plan request in place that this is the production, etc. I think, we are in dialogue already.
So, Vivek, what I take from that conversation really is that, yes, you guys are constantly talking to the government. There have been measures that we have seen come in on this week. But as you rightly pointed out, much that has been done would be to discipline, is more psychological, sentimental in nature. But Avinash, coming to you, how does that calculate or weave its way into prices then? Of course, we have seen a knee-jerk reaction coming in for prices. But how much longer and how much higher do you see prices moving from here?
Number one, since there is surplus production this year and an expected surplus next year, obviously the prices will be under pressure. So difficult to say whether it's going to improve by 2 rupees or 3 rupees or 5 rupees. That's a very difficult estimation to make today. Talking about the global market, I've just come back from the largest sugar conference in the world, that's in Dubai. All the top traders, all the top producers are there. And we got some news from Brazil that Brazil might be reducing their sugar production in this season that they're producing from probably April or May when they start. And they might reduce their production by anywhere around 3 to 4 million tons, mainly because the crude oil prices are improving. And because of that, the ethanol prices might be lucrative for them. And therefore, 3 to 4 million tons might get moved out of sugar into ethanol. So that space of about 3 to 4 million tons could give some kind of a fillip, some kind of a push to the global prices, and there could be an opportunity for India to export some of the surplus.
And it's not just India who's looking at a surplus this year and the next year as well, as both of you have pointed out, but the global markets are looking at a surplus as well. And the latest reports show that at around 8 million tons for the next year. Vivek, with those numbers in mind, what is your sense on the prices then?
It's very difficult to hazard a guess. See, we were at I've mentioned to you, we were at a low of 31. We are 32 quarter. All I can say is probably after the month of April, this should move up. From now to April, maybe around this range only. After April, move up. But not move up to earlier levels. That's not, won't see that for 2-3 years again.
Well, I hear both of you that the prices will gain, but not too much, especially when we are looking at a surplus for the next year as well. But before I let you go, Avinash, one more word from you, and this is about the big gap that we see in the ex-mill prices and the retail sugar prices, because even as the ex-mill is trading at 30-32 rupees per kg, the retail is still holding around those 45 rupees per kg marks.
Yes, you're right. The ex-mill prices have come down by 6 to 7 rupees in the last 3 months, but the retail prices have come down by around 2 to 3 rupees only. The market generally says that the retail prices are generally downward sticky. So somebody who has bought at a higher price doesn't bring down the prices as fast. So there is always a gap. I don't know how this gap can be reduced. There was a proposal, or there can be a thought that if you add a cess on the consumers, because the big consumers or the large consumers are getting an undue benefit or a big kind of a drop in the sugar prices. So therefore, if you charge one extra rupee or couple of rupees of cess and collect and give it to the farmers towards the FRP, that will not only reduce the gap, keep it at a normal level, but will also ensure stable prices in future, and yet give some revenue to be given to the farmers as part of the cane price, which will also give relief to the sugar industry. So what I suggest is, whenever this gap between ex-mill price and retail prices become too large, then obviously somebody is making some extra profit somewhere. Why not take a part of that and give it to the farmers?
Well, that's a valid point, but that is the big sugar discussion that we slated for you. Thank you so much, Vivek and Avinash, for joining on to this one and explaining to us on what it really means. So the import duty hike, the export duty scrap, and of course the discipline coming in via the release mechanism are some 3 factors that can support sugar prices going forward. Good one for sugar prices and of course the sugar mills as well. Now we turn to our focus on metals and crude prices, and what a decline have we seen in this sector for this week. To discuss all of that, we are now joined by Kunal Shah of Nirmal Bang Commodities. Also joining us is Priyank Upadhyay of SSJ Finance. Gentlemen, hi, and thank you so much for joining us. Kunal, you go first. And 7% of a cut in crude oil prices in this week. We've turned negative for 2018. Is there any support, any floor in sight yet, or would you still expect some more decline?
I think for the timing, it seems to be a little overdone. We've seen recently US oil production have moved up to 10.25 million barrels. So the average of the 2017 was 9.3 million barrels. So suddenly a spurt in production by 1.1 million barrels. So going forward also, the number is likely to be somewhere at 10.5 to 10.6 million barrels per day. So I think the broad call for the oil is 71, 72, Brent has peaked out, 65, 67, WTI has peaked out. And we are not going to see crude oil making new highs for the year. Even though the global growth remains strong, the probability for crude to move up exponentially remains very low. So I think from these levels, we won't recommend to go short. We are likely to see some bounce back. We are seeing some risk aversion in the global markets. So on account of that, WTI may test levels of 60 to 59.50. That's it for the time being. If you are short, if you're having short position, you should book profit at those levels, and perhaps you can go long for the bargain hunting.
Priyank, what is your sense? Have we made peak for 2018, or do you see some merit in all of those reports from global bankers where they expect the prices to go to 75, 82 by third quarter of this year?
See, the main factor to drive crude oil prices in near future would be the demand and the growth prospect around the world. I agree that there is a supply glut in the market, and US production at highs at 10.25 million barrels per day has increased, but over a period of time I see 65, 66 what the initial resistance we have seen, and from there we have seen a correction. I feel 60, 59 could have a good support in the market, and ideally we should head higher towards bounce back rally, I can say, towards $63, $62 to start with. So once prices breaks out above 65, 66 convincingly, we can head to higher levels of around 70, 71.
All right, so some bargain buying perhaps can be seen at these levels, but yet another area has been the base metal prices, which also saw a decline in this week, anywhere between 3% to 5.5% on the higher side. All of these metals which were making all-year highs, multi-year highs in the month of January clearly has turned around in Feb. Kunal, anything that you are picking up here? Because, of course, China is headed for a Lunar New Year holidays, and before that, we do see market jittery. Is it just about that, or do you see more merit in this?
Well, two triggers. One, like you rightly pointed out, Chinese Lunar Year, so the traders unwind their position and go to the holiday. And the another important reason is the kind of decline we've seen is because of China's property index have corrected by 5%. So with the ongoing pledge by the government that the leverage state-owned companies will definitely reduce their debt, is definitely raising some concerns in the property market, and hence we have seen some reasonable amount of correction. Going forward, we are not bearish on the complex. We are of the view that the global growth remains strong, and on account of that, metal prices should do well. So I think these are the corrections one should use as a good buying opportunity. So I think nickel around 820 looks very attractive to us to go long. It's trading at 830 right now, and one can go long and wait for the targets of 860 to 870 going forward. Even same copper looks very attractive. If copper prices declines to the levels of 432, 430, it again remains very attractive buy for the upside target of 450. And another metal we feel is looking very bullish going forward is lead. 160 good levels to go long in lead for the upside target of 168 to 69.
So Kunal is picking up nickel and lead as long positions there. Priyank, where do you see strength coming in? Where do you see stronger fundamentals? Are you coming out with some buy calls here as well?
See, across the base metal complex, we have seen a decent rally from 2017, and even that continued in 2018. And with a correction in prices, the longer term and the medium term trend still remains on the upside. I would term this as a short term correction. With a rise in dollar index in the last few trading sessions, we've seen a pressure on the commodity complex. But this correction, I guess, would be on the lower side, would get supported. If I talk about aluminium prices, aluminium would have a support of around 136, 135. So it's trading around 138, 139 currently. So holding 135, I feel we could head higher again towards 142, 144 mark. Again, zinc prices, we have seen a wonderful rally. It went to 230. Saw correction towards below 220. Right now the supports are in the range of around 212 to 210 on the downside, and coming to that support, so we could see a bounce higher again towards 225, the recent highs. Going to copper and nickel, these two counters also has been beaten down from approximately 900 prices. Nickel has trading around 830. The short-term supports for me would be around 800 and 780. 780 is a very, very strong support. So unless and until it doesn't close below that, the longer-term trend remains on the upside.
All right, so even as it has been a dismal week for base metal prices, both of our experts really are trying to cherry pick or bargain buy on the lower sides. The fundamentals, of course, on the longer side are still supportive. Another sector which actually did see some safe haven buying as the week began, but let go of that as we head towards the end of the week, is the precious metal space. Kunal, how do you look at the 1% decline in gold, a 5% of a downtick in silver for this week? And is there any hope as we head into the new week or the next quarter for that matter?
I think the longer-term fundamentals for the gold and silver remains very attractive. We are very bullish for the year 2018. But I think most of these gains are we are likely to see this kind of gains in the second half of the year rather than the first half. First half, also we are going to see some upside. I think it's very surprising in spite of the fact that the volatility in US global markets, equity markets have moved up drastically. There has been a correction, there has been a lot of concerns, and in spite of that, gold prices have declined. So the key victim here was the US job report that indicated that the US job growth remained very strong. So the likelihood of US real rates becoming positive have become reality, and because of that, gold and silver are not doing well. But I do not recommend to go short at these levels, even though it can slide down a bit further, a tad lower from here, but 37,500, 37,600, good levels to go long in silver. Even for that matter, gold looks very attractive at 29,700 to 29,800 to initial long position. So somewhere I think it should stabilize during next week and should gradually move up from these levels.
You know, buyers of gold also look at the Indian prices and they want to know what you could see as prices by the end of this year. So, Kunal, if you had to buy them today on the dips, what is your sense on where we could see the gold prices by Diwali or by the year end?
Yes, I do not expect gold prices to go below $1220, $1230 for the entire year, and I expect on the upside we are going to see gold for this year may test levels of $1,400 to $1,450, and for that same reason silver also looks attractive and can test levels of $20 to $21 and $21.
All right, and before we let you go, Priyank, what is your sense? Are you picking anything between gold and silver, or would you like to go bullish on both of them on a longer term?
You see, from the longer term perspective, the trend remains on the upside. In spite of weakness around the globe in equity markets, gold hasn't performed. The main key reason is the expectation of the Fed rate hikes are limiting the upside in the market. But still, I feel 1300, 1280 on the short term are providing a good support to the market, and we could head higher again towards 1350, 1360 going forward.
All right, so we have bullish cues coming in for most of those commodities going forward. Of course, this week is nothing to write home about, but that is the view coming in from our experts that buying on these dips for a longer term perhaps is a bullish or proper strategy to go with. Priyank and Kunal, thank you so much for joining us and giving us your strategies. And with that, it's completely out of time on this edition of Commodity Champions. Stay tuned for more for CNBC TV18.